companies that have reported so far in this earnings season, by and large, regardless of sector, seem to be managing to hold the line on margin and, in fact, to be able to deliver on both the top and the bottom line at the moment. Does that continue if we continue to see headline CPI rates of 5 to 7% in the developed world?
Yeah, good morning. I think it's important to point that out. Margins of corporates, non-financial corporates, have surpassed pre-crisis levels and are now 2 percentage points above, right? So we did have the very strong recovery in turnover, which allowed for profitability recovery. And despite the fact that input prices have reached record high levels, right, even beyond the 2011 post-great financial crisis that we have seen, we do see a limited number of sectors that actually managed to have the pricing power that they were looking for in 2021. So if I give you an example, both in the US and in Europe, we had 40% of them that managed that. So in the US is more than the long-term average, right, which is 25%. So there was more pricing power in the US, also demand was stronger. But in Europe, it is less actually, because more than half of sectors have this pricing power. And actually, I think it's interesting to see that most of the surveys are pointing out to a higher catch-up effect from Europe in terms of the willingness of corporates to increase further their prices, right, in 2022. But I think it's a dangerous game because in 2022, we are reaching the peak, right, in growth, and we are actually expecting slowing demand, which will make this willingness very difficult to become a reality. Actually, when we look at long-term relationships in terms of how much sectors have leeway to price better, there are a few of them that manage. And we do see air transport, food manufacturing, textile, computers and telecom. So there are a bunch of them that will manage to, but not the majority. And clearly that's a bit of a risk where you want to increase your prices while you know, or you should know, that demand is slowing down. And if we think about 2021, it's a bit the same story where we were lagging in rebuilding inventories because we were unable to anticipate the grand reopening. And then we created, or we amplified, the supply shock, which takes time to reduce and actually ends up into the higher inflation numbers. Of course, it's not only about inputs and inventories, but it's also about energy.
So what is the biggest fear here, do you think, for markets? That inflation runs riot and kills off consumer demand because wages are not keeping up with price hikes, or that central banks, in fact, make a mistake by hiking rates too aggressively, too early, before it's clear whether these supply chain related pressures will wash out later this year?
Yeah, definitely. Everybody knows that in H2 inflation rates will be lower, and core inflation even lower. And actually, we do see limited pressures in the services sector. It might be higher in the US and the UK, but in Europe, it's really contained, which actually means that this inflation, the source of inflation, is due to a shock which is meant to be resorbed. It takes longer, but it will be resorbed. So indeed, if we are going to get too aggressive, then markets will start to wonder what's the capacity of corporates, which we know are very indebted currently, to actually manage cash flow, right? If we think about the cash buffers that we actually pointed out in the report, we do have indeed 690 billion euro in Europe, more than $750 billion in the US. But the problem is that the source of this cash is not the same. In the US, it's pure cash because a lot of the loans have been forgiven in 2021. But in Europe, it is debt. So debt that will need to be refinanced at one point. And what markets might start to worry, if rates are increasing more than 100 basis points, what would that mean for the investment cycle if we have a deleveraging process? And I think clearly that's one of the major concerns. I think the market expects that 100 basis points, 150 basis points be absorbable at the corporate level, but also at the household level, because we still have some excess savings. But if we go beyond that in an environment of lower inflationary pressures and slowing demand, that could be even more harmful. And that's on the private side. And then we have the sovereign side, right, where we also see some normalization in yields. And clearly, the stimulus plans are still bringing some cushion here. But in 2023, even in Europe or in the US, we might have worries being much higher. Not to talk about the emerging markets, where it's true we have a taper tantrum, but we still have a huge amount of debt that arrives at maturity in 2022 and 2023. And that's COVID debt that will need to be refinanced in an environment where private, public sectors are very dependent on money supply. And this money supply is being withdrawn. So we are going to normalize, maybe in some cases in a bumpy way. And that's clearly something that arrives in an environment where not everywhere we are back to pre-crisis levels. Right. Not everywhere the recovery has been full.